Hi, and welcome to the next episode of Web3 from the Clueless Capitalist. My name's Osman, and I'm here today talking with Omar, where we left off on the previous episode, where we had a really good conversation about Web3 in general. And now it's just time to go a little bit more in depth into some of the more interesting parts of Web3 that I think of, specifically around like DeFi. What is DeFi? Because where we really want to take this conversation is for all of the audience that typically watch our episodes is really to understand how does this all eventually translate into Web3 startups that we might come across, because the biggest issue that both me and Razi have is that we just don't know. We don't know what we don't know, especially when it comes to Web3. So, Omar, thanks for joining us again and giving us the previous insights that we had. I think we kind of left it off on covering the basics of what blockchain was and some of the philosophical components of that. But we didn't really get into the detail around, what is decentralized finance or DeFi. Kick it off from there and let's see where this conversation goes.
Fair enough. And Usman, it's my pleasure to be back. I just enjoy being here. You guys asked some very interesting questions, and I thought that the last conversation we had was we could have gone on for hours, and we might be in danger of doing that again today. So we'll see how it goes. So decentralized finance is basically using blockchain technology to provide financial services and products without intermediaries and middlemen. Right? Today, you rely on your bank to give you a checking account or to give you a loan. You rely on your insurance company to basically give you insurance products, and you rely on your brokerage or maybe private bank to provide you with wealth management capabilities. Now, the promise of decentralized finance is, hey, we can make all these products available in a friction-free way for people to go direct to the source of the product without having to go through your major financial institutions. How does it work? So let's take an example of how that might work. So for instance, if let's say you want to buy a security, right? In the traditional finance world, you would go to your broker, and then your broker would have, ideally all the listed stocks and ETFs that they offer, and then you pick one and you buy it. But in the blockchain world, instead, you don't have stocks, you have tokens, and each of those tokens represents a share of something, which could be either tangible or intangible. So we'll talk about what tangible. A tangible token is, a token that is used to, let's say, power a blockchain. So just coming back to the mechanics of blockchains is, I said it earlier, blockchains are rails and crypto are the trains. But the other way to look at it is that the native crypto of a particular blockchain is basically the toll or the reward given for using that blockchain. So for instance, if you look at the Ethereum blockchain's native token is the Ether. And if you do your part to manage transactions and support the ongoing operation of the Ethereum blockchain, you get rewarded in Ether. Similarly, if I as a user transact on the Ethereum blockchain, I have to pay a fee, and in the case of Ethereum, that fee is called gas. And basically, gas fees are there to pay for the cost of doing that transaction, and indirectly, a portion of those gas fees go towards the reward for the validator who confirmed that transaction on the blockchain. So you can see it's a complete virtuous cycle. Now, you can of course buy Ethereum tokens and hold it as a security. It wasn't meant to be that. It was meant to basically allow for a flourishing blockchain ecosystem, but you can absolutely hold an Ethereum token as an asset. And just like you would a stock, you can go directly to maybe an exchange or a decentralized exchange and convert your fiat money into some online equivalent, which then allows you to directly purchase any number of Ethereum tokens. And it doesn't have to be Ethereum, it can be any token that you want. But the key word is to get your money on chain, and then you can do whatever you want. You don't have to rely on Morgan Stanley or Charles Schwab or Fidelity or any of those others. So you look at that from an investing perspective. If you look at these tokens as investments, you can buy and sell any token anywhere worldwide. You don't have to worry about, whether that's a stock that's only traded on the South Korean market or this is an India specific stock, tokens are borderless. So for you to buy a Solana token from South America is the same as buying it from South Africa. It doesn't make any difference. It's the same Solana token, and you can transfer it to your wallet wherever in the world you are. So that's an example of, very simple example of, decentralized investing, the ability to buy and sell tokens. Does that resonate? Any questions on that?
I think it really does make sense, just in terms of the basic experience I've had with regards to like buying a token or taking a token and having it on my own wallet. So that makes sense. It kind of leads me to that feeling that I had in the back of my head when we talk about blockchain. There just seems to be this connotation that it's not well liked by traditional finance. And is this the reason why? Because suddenly you're eliminating the need for banks to be that intermediary. Their kind of purpose is now redundant. Is that one of the reasons why bankers don't like?
I don't think so. I don't think that's a problem yet. I'll tell you why banks don't like it. Well, first of all, the onus of regulations on banks is to ensure that any crypto that they touch on behalf of their customers is clean crypto. It hasn't come from, some hack. It hasn't come from, risky, dodgy sources. So that means that then banks have to really up their game in terms of their AML, anti-money laundering, and know your customer requirements. So I'll give you an example. For instance, an equivalent is, let's say you came into your local bank with, $500,000 and you wanted to put that as a down payment on a house. The first thing the bank would ask you is, hey, where did you get this money from? Now, if you transferred it from another reputable bank, end of story, because, everybody assumes that bank has done due diligence and surely they have tracked that money from some source. But if you come in with $500,000 and say, hey, I made it really big in Bitcoin, well, that sends banks into a whole panic, right? Because they don't have the capabilities or the processes in place to validate that. All of those coins that make up that 500,000 were all yours, and they all came from legitimate sources. And then the other problem is that not only is there uncertainty about how to tackle it, but also uncertainty of how far back to look, right? The thing with blockchains are they're immutable. So I can have a coin today in my wallet that can have gone through 500 other wallets before it, right? Each transaction is there forever. Anyone who wants to take that walk electronically can. They can, trace it from me to the person before me, to the person before them, to the so on and so forth. But the point is for banks is, hey, how far back is good enough? If I'm 5 wallets away from a hacker, is that good or not good enough? If I'm 100 wallets away from a hacker, is that good or not good enough? So KYC is a problem, which is why, when people see crypto as a source of funds, they get very nervous, right? The second thing is that I don't think we are at that stage yet. I don't think that crypto has reached that level of widespread adoption where banks should worry about, maybe, losing out on, checking account balances or things like that. But, payments, however, is one where, you can. I mean, if you think about it, today, banks take nice size fees when you want to make a cross-border payment, right? Because, you pay out in Sing dollars, and then the recipient wants to receive the money in, let's say, Malaysian ringgit. And so there's a nice conversion fee built in. And for banks, it's highly profitable, right? Even though there's no more effort required to move 500 Sing than 5,000 Sing. It's electronic money. But in crypto, when you can go peer-to-peer, I can just send you the equivalent amount of that in Bitcoin, right? And you don't even have to convert it. We're not looking at converting it to any traditional asset. We are happy to keep it Bitcoin to Bitcoin. So from that perspective, it can potentially be a big risk for cross-border payments, for remittances, things like that. So I think that's one area where banks are a little concerned, could be a little concerned. I don't know how many of them are worried just yet. The third thing is that especially when you are a private bank client, right, and you're looking for alternative assets. So alternative investments would be, the more exotic stuff, like you might be investing, for instance, in, real estate or something a lot more specific. Then private banks pride themselves on having broad asset coverage because, hey, whatever you want to invest in, I can give it to you. But if they're not offering crypto, then that means that that's a share of wallet that the customer is like, well, I went to, let's say, UBS and they don't give me crypto, so I'm going to go get my crypto exposure elsewhere. So you may be giving up on a share of a user's wallet that is available for investing. So those are just some of the examples. There are other things you can do in crypto. For instance, you can do lending, you can do insurance. Lending is reasonably developed, but it's still very peer-to-peer. I'd say insurance is one of those where, there's still a lot to be done. The promise is there where, you can end-to-end underwrite and provide somebody with a policy and you can make a claim without any middleman. But, I've yet to see somebody convert that into an ongoing winning proposition. So, those are examples. I mean, from an investment perspective, from a remittance perspective, and like I said, banks just don't like crypto customers because, there's of course some sort of implied volatility in their business operations. And B is if you're a private retail customer, then there's always the question mark of, well, how did you make your money? And then when the regulator comes asking, as a bank, I better have the right answers.
I've got my own opinion on this. And I actually don't know whether that opinion is pro crypto or bank or anti-bank, anti-crypto.
Yeah,
it is very conflicting. And the reason why I say that is because, if I try and remit money back to the UK to give to my mum so that she can pay her bills and stuff like that, I have to jump through a number of hoops to prove that I earned this money. And the bank will quite rightly say, where did you get this money from? And typically it's a few questions, but it means that the money's held. And it's all vague and it's opaque. Why did they withhold my money? Why have they put it to one side? And typically it can be as simple and innocuous as, your name's Osman Ahmed, therefore you fit a particular profile, and therefore I'm going to withhold your money. You're going to have to prove certain things for me. I'm not saying banks are racist. I'm just saying that it does happen more often to me than it does to other people. Now, that being said, if I happen to be a big oligarch from Russia, prior to all of the crackdown that happened with Russian money, if you wanted to transmit $10 million into a bank account in London and buy a house, you could. And I don't think they were having their money withheld, whereas me trying to remit £1,000 to my mum is going to have a problem. So my particular issue with some of these things is that it's very arbitrary. It creates lots of problems for what I would term your regular middle class. But if you're ultra wealthy and ultra in that top 1% of the 1%, none of this matters in terms of AML and KYC and all this kind of stuff. It will happen. Private bankers will make things happen for you. And therefore, whenever I hear people say, this is the problem banks have, it's not a problem if you're rich enough. I don't know whether that means that I'm really pro-crypto or not. I understand that you could be literally 5 steps away from having a coin that belonged to a North Korean hacker. Your $10, $20 that you have in your wallet was probably 2 steps away from somebody peddling cocaine on the side of the street somewhere. What's the difference? I get that there is one, but it's well, if you couldn't do it before, well, why is this a problem now? Creating a problem just to kind of justify an existence. Is that, you see my conundrum? I'm kind of conflicted in how I view this.
No, I hear you. Look, I think that there absolutely does need to be some standard of regulation, right? I don't think it can be completely it's crypto, let's not worry about it. I absolutely think there should be some standards, regulatory standards around crypto. I think that, again, crypto's biggest strength is, ironically, in the traditional financial world, its biggest weakness, which is immutability and transparency, right? You would think everybody would be really happy about that, a ledger of transactions that can't be fiddled with that anyone can see, but no, they really don't. And actually, when you think about it, in the banking network, when banks pay each other via SWIFT, if you pay me, then it goes from your bank Swift account to some intermediary bank to another bank to eventually to my bank. Basically, whoever has the relationship and whatever is the fastest way for it to get from you to me in our preferred currencies. Right. So that's maybe at best it's maybe 5 banks in the middle, but in crypto, you get like so many more. The other thing is that in the traditional payment system, right, every bank can only say, hey, I'm only responsible for what I'm responsible for, right? I can't tell you what the bank before me did, and I can't tell you what the bank after me did. Yeah. But in crypto, if I let something go, then somebody can potentially ask me saying, hey, who told you to release those funds to that known hacker wallet? You should have known better. So the thing is, I am in favor of standards. I think once you get regulatory standards in place, it makes adoption. It's also easier to write processes around it. If you're looking for X, then you need to define what X is. And so people say this is either X or not X. In which case I either allow it or I will block this transaction. And we're not there yet. And I think part of it is industry and regulators are trying to jointly figure out what's reasonable. They're going to need to take a risk-based approach. I think right now it's like, hey, if I know it, I'm responsible. And since I know everything, I'm responsible for everything. And that'll never work.
And so why are certain jurisdictions seem to be more favorable to blockchain technology? So if I was to, just based on what I hear in the papers, it seems like the United Arab Emirates seems to be like a pretty favorable jurisdiction companies running the blockchain. And Singapore has like a love-hate relationship with it, from what I can tell. One minute they're saying that they're very pro, and then the next minute they're cracking down on certain companies that are running exchanges. So why do some countries have different views and opinions? I mean, we standardize things, right? And all of these other countries still haven't quite worked out whether they're pro or not.
Right. It comes down to really understanding and also, tolerance for innovation and the tolerance for risk, right? In fact, some of the early crypto exchanges, the jurisdiction you mentioned, they are like respectable jurisdictions. The ones that started out were in very, very dodgy places, in the kind of offshore havens you would expect to find stuff. So, some of them are still there. That's where their registered headquarters are. But the thing is that, these new financial centers, they believe that this is the future of finance. Then, they try to build principles that then become the basis for, regulatory requirements. And I think Singapore sees itself as a financial hub. Obviously, it is in Asia. And Singapore is not anti-crypto. Singapore is anti-retail crypto. Singapore is all for institutional blockchain usage. And obviously so much work has happened with Project Ubin and Project Guardian, and now a very deep exploration of central bank digital currencies and things like that. So the regulator in Singapore is pretty savvy. What they're worried about is that can this be a big black hole when it comes to retail investors, and can it open up Singaporean citizens to overseas scams as well, right? Because it's easy to extort somebody when you are dealing with a borderless currency. And so that's Singapore's mindset. When you look at it against Hong Kong is still open to all kinds of crypto developments, right? However, having said that, they have been a lot slower to issue licenses to exchanges. I mean, so, Singapore has issued more licenses net than Hong Kong has, so there is that as well. When you look at the UAE, what's in it for them? Well, the hope is that then they become the financial hub for crypto, right? So more companies will relocate their headquarters there, which raises the profile of the region, hopefully brings in some high spending owners, more wealthy people. And so that's the goal. I think everyone is trying to say, hey, we like it, we think it's got potential. What do we need to do to make sure we attract the right kind of crypto founder and not the wrong kind? And the problem is fineness of that net that sifts out the wheat from the chaff is being developed as we speak.
Interesting. I'd never really given it that much thought for other than just on a superficial level. Let's just go back to the different types of blockchain, or even if that's the right terminology, but we keep on hearing about layer 0, layer 1, layer 2.
Correct.
What are they? I mean, like sometimes I speak to founders who are saying, hey, I've got a great solution. This is what we're doing. And they'll tell me that it's a layer 0 or layer 1. And by that time, my eyes have already glazed over. I just don't understand the terminology. So
right.
Give me some insight.
Absolutely. So think about a house, right? And layer 0 is the foundation of the house. It's the stuff you don't see. But everybody stands on it, right? When they walk in to your house. So that's layer 0. So examples of layer 0 would be like, a polka dot or an avalanche would be layer 0s. So you can also think of them as, sort of blockchains of blockchains. I mean, that's not the world's most accurate term, but that's how somebody might describe it as a layer. Layer 1s, they are the blockchains you come into when somebody walks in through the front door of your house. There's your living room, there's your dining room. That's your layer 1. And most of the blockchains that you are familiar with and I'm familiar with would be layer 1. Coin and Ethereum and Solana and Polygon, etc., are all layer 1. And then layer 2s are, when your house runs out of space and you add an extension, a second floor, that's a layer 2. So a layer 2 is designed to take the heat or the burden off of the layer 1. So examples of layer 2 would be like, Arbitrum or Optimism. These layer 2 blockchains are built to sort of act as side roads on the congested highway that is the Ethereum block. So the idea is the Ethereum blockchain is so busy that not only you can't get your transactions confirmed quickly enough because there's network congestion, and the cost of doing a transaction can be pretty high, it's very difficult to build a scalable business on that when you're not sure how quickly something can be done and how much it's going to cost you. And so that's where layer 2s come in. The layer 2s will take some of the pressure off the main chain and then later on sync back to the main chain in terms of the transactions that were confirmed. So layer 2s then run faster, run cheaply. They will in the end sync up with the layer 1 because the layer 1 is sort of the ground source of truth. But like I said, again, think of the layer 2 as the side road, the one that you use to bypass traffic jams on the main interstate.
I mean, this kind of reminds me of my and the acronyms were, you'd had your physical layer at the bottom, and this is like taking me back now. But you had like 7 layers. Princess Diana never tried shagging Prince Andrew, where the physical layer is the cables that connect everything together, the physical stuff. The data layer sits on top of it, the bits and bytes. The network layer is like how that's segregated. And then obviously the application is the application, the stuff that we run on our PCs. That's the top layer. And I think we're referring to here with a layer 2 on the blockchain is something like subnetting a network. So you have like a very big network, and then you've got these smaller pockets of network where you're keeping the traffic local to it. And then when you're ready and it needs to go onto the main network, it does. So you're not shouting across everybody. It's like a pretty crude analogy, I think, but I think my network background will probably understand that.
That is an absolutely beautiful telco analogy. One other maybe lay person way to think about it, or just from a general technology perspective, is the good old front end and back end, right? So you can think of a layer 1 as both front end and back end, and layer 2 as a front end. So what it does is, with a layer 2, because you take some of the processing power on the front end or some of the processing work on the front end, it puts less pressure on the back end. Whereas in layer 1, everything is happening to everything, right? I mean, it's the front end, it's the back end, it's end-to-end processing. So when it's running slow, it's whatever you're doing. Whereas when you move things to layer, you can find things happening very, very quickly and very, very cheaply. And then you're not really fussed, at what point the layer 2 and the layer 1 sort of sync up and align, because that's built into their architecture.
Yeah, it does. Just had a separate thought, potentially could go into a bit of a rabbit hole here, but this layer 2 tornado Was
No,
Tornado like
no.
or
That's
not?
no. Tornado is something completely different. So Tornado is basically is a service, right? And it's a service called a mixer. And what mixers do, originally designed to be private sort of guardians, right? In the sense that the way a mixer works is different coins have different mixers. But the way a mixer works is, let's say Usman deposits, 2 Bitcoins into a mixer, and Omar deposits 3 Bitcoins into a mixer. Now the mixer is 5 Bitcoins. And what it does is it mixes it all up and then allows you to withdraw different amounts to different places. So now it's very difficult to know, hey, which of these Bitcoins was Usman's, which of these was Omar's. And so if anyone is trying to track it without knowing wallets they own, it's very, very difficult to own, because the quality of a good mixer is, and I'm just talking about mixing 2 batches of stuff, but real mixers are mixing like thousands of batches of coins all the time, dispersing them in different ways based on how the algorithm is designed. So mixer is a service. It's basically code. No one's necessarily running it, but it's been written. It's code. You send your stuff to a mixer, and then there it does, and then you get to choose how and where to withdraw it. Most mixers are on layer 1s. I don't think I've seen a layer 2 mixer yet. Could be wrong, because there are new ones coming up all the time. I don't think anyone would code or create a mixer for a token that doesn't get traded much or isn't worth much, because what would be the point? Why would I try to hide pennies? I would be more focused on hiding thousands and millions.
I mean, it goes to a comment somebody once made about fraud and criminality, and I said, look, it would have to be like a significant sum for it to be worth my while to even be remotely tempted to do anything. And I think kind of reiterates that point, really, in that for these types of things, you want to do it with huge volumes rather than small amounts.
And just the last thing on Tornado Cash. Sorry, just one last comment on Tornado Cash. And the reason why you probably brought up Tornado Cash is because Tornado Cash was sanctioned by the US government. And that's the first time code has been sanctioned. Normally, organizations are sanctioned or countries are sanctioned. But this is the first time that code has been sanctioned. So, the US, I believe it was the Department of Justice, said, hey, we don't care. It's decentralized. What we're saying is that this service is sanctioned. So anyone who is dealing with it will be kind of dealt with as if they've dealt with a sanctioned entity in violation of international law. So that's pretty powerful. But that's to the extent that you can think of, like, here's a service that's designed for one thing, but of course, treasured by hackers and deep state actors, because it allows them to basically launder their proceeds.
Yeah, we definitely don't want to do that.
Go ahead.
This goes back to the point around the whole, like, the Wild West feeling that I have about blockchain and crypto and Web3. There just seems to be so many things that are going on that you can easily get caught out without even knowing. If it hadn't been for a news article that I bumped into, I wouldn't have known, and I would have just thought, let me try this one out. and just because I'm curious, I'd want to try. I'll try it because that's how I learn. I usually learn by doing, and this is one of those things where you could easily become. Well, I think it would be easy for me to stumble across this and then go, let me just put my Bitcoin into here and bring it back out and see whether it works. And by default, now I'm a sanctioned individual, hunted by the law.
Yeah, you've broken the law. I mean, that's exactly why these things are coming about, right? When there was an analysis done on Tornado Cash, they're like, hey, almost everybody who steals anything in Ethereum. By the way, Tornado Cash is an Ethereum mixer. So anyone that is actually, is Tornado Cash an Ethereum mixer? I believe it is. I might be wrong. I believe it's an Ethereum mixer. But if anyone steals something, it usually goes through Tornado Cash, and so the U.S. Department of Justice said, hey, we're not saying everybody who uses Tornado Cash is necessarily doing the bad thing, but the fact is enough of the bad guys are using the service, so the service technically can't be shut down because there's no switch, the main switch that you can just turn it off. But what we can do is we can ring fence the service so that if anyone, pops over that fence, now that they know and it says do not, trespass, you must be up to no good. So okay, you have to build rules that can apply and can be sort of enforced. That'll exactly address the Wild West element of it, which I 100% agree is still very much there. I mean, it is an emerging, it's still very much an emerging technology. We are still, I would say, in day zero stages.
Wow. Okay. So if we try and tie this all back to like the Web3 type of startups that we're seeing and that we see it being incubated, what are the things that we essentially need to know to be able to determine whether founder is onto something good or not? Because I mean, we mentioned this before, blockchain is a solution waiting for a problem, and most of these are identifying problems and creating the solutions for them. It's just whether we call it product market fit. Is it something that people are willing to pay for? So what are some of the key things that you might be looking out for when you're talking to a founder who's telling you about their latest and greatest Web3 startup?
They aren't very different from how you'd evaluate any other startup. I mean, I think the first thing you probably start with is who are the people, right? What are their track records? Do they look like people that have a high level of integrity, and do they have a high level of commitment, right? So those are the things you'd look for from a founder, as you would look for, in any other startup. The other thing is obviously ensure, each of those people has a role, like in the company. You don't want amorphous titles in the organization. You're like, who's the CEO, who's the CFO, who's the CTO, etc., etc. You want to make sure that everybody has a specific role and title. And then, quite honestly, you look at what are they trying to build and who wants it, and then how are they planning to fund it. Are they going to issue a token? If they're issuing a token, then obviously that raises a lot of questions, because in a lot of places you can't just issue a token directly to people. I mean, it has to be registered as a security, but the problem is registering as security isn't clear across jurisdiction, right? So you'd look at the founders, you'd look at the quality of the idea, you would look at their plan of how they plan to fundraise, and then the next thing is you'd look at what kind of research have they done in finding product market fit, who are their competitors, and is this something that is especially true in the crypto space? Is this something that can endure? Because you may have instances where you have a phenomenal arbitrage for like a year, right, or 2 years, and then after that, if the entire company is just resting on that arbitrage, then they're going to be dead 3 years from now. So they're not terribly different. If obviously, like I said, you want to understand their strategy, one of the things, depending on what kind of project people are building, let's say for instance someone is building a new brokerage solution or a new custody solution or something like that, you would ask, of course, what blockchain are you building this on and why? And that's going to be pretty telling as well, right? Like what's important for them from a customer perspective. And then of course, what is their plan to acquire customers? Are they going institutional? Are they going retail? What is their timeline? Who else have they talked to besides you? One group of people that get a bad rap, and I don't think it's completely undeserved, is crypto VCs. Now, I'm not talking about the respectable VCs like, your Andreessen Horowitz and Sequoia and all these other guys. But I'm talking about the crypto VCs that are basically looking for companies with tokens to shill that they then put money into, and then everybody builds a whole lot of hype around it. The tokens price skyrockets, the VCs exit pocketing their money, and then the token collapses. So those are the kinds of things I would kind of stay away from. And that of course happens when really the company has nothing to offer. If your entire value proposition is a token, but it's not backed by anything, you're not building anything, there's nothing tangible behind it, then it's useless, right? Basically, you're just hyping junk in order for someone to pay for it so that you can in turn say, oh yeah, okay, I've made my money, it's junk, let's get out, let's move on to the next game. And so I would look at things like that. I would look at, if for instance your founders are builders, I'd look at what else they've built, if they've contributed to, if they've been great citizens in different different crypto ecosystems, that's a sign that, they've been committed. If, like, for instance, you've got developers that have, built a lot on, let's say, Solana, and you've seen their track record in terms of, the projects they have on GitHub and things like that, then that makes it credible that they would build their next solution on Solana because they've had a long association with that blockchain, right? So you're trying to find the connective tissue in the story. You're trying to determine, are these people, who are familiar with blockchain, but also familiar with the challenges of the real world. A lot of times, a number of blockchain founders think that, hey, if I'm decentralized, I don't have to answer to any regulator. I don't have to worry about, registering my token and all that stuff. And that nothing could be further from the truth. That loophole is closing rapidly, because I think that even if regulators are not sure what they will allow, they are becoming pretty clear on what they won't allow. And that kind of story won't fly. I mean, I just wrote a LinkedIn post, well, it'll come out tomorrow, on this decentralized social media network called BitCloud, and their founder just got arrested on the 30th of July of this year for basically illegal fraud and illegal sales of securities. Why? Because he raised $257 million from getting Bitcoin in exchange for his native token, and used it to build a network, which actually the network hasn't done too well either. But that money, allegedly decentralized, found its way into his private wallets, funded his mansion, funded gifts for the family, and eventually the regulators are like, okay, this is not decentralized. You're a US citizen. I'm going to bust you. So, these are the kinds of things you have to look out for. I would, it's very important to, when you're not sure, bring in other people who maybe are a little bit more familiar with the industry and say, have you heard about these guys, or have you heard about the chain they're building on? And, you have to kind of put things through the smell test. So unfortunately, there's no one size fits all, but typically, it wouldn't be terribly different from how you'd look at any other founder, right? You'd be looking for credibility, a clear business plan, a customer problem, a realistic go-to-market strategy, and how they're going to fundraise.
Yeah. I mean, historically, sometimes when I've looked at somebody saying, yeah, we're building this on the blockchain, me being me, I'm just thinking, well, why can't you just put this on a database and kind of like do a data back? I mean,
I agree.
And so I'm really trying to understand, why is the blockchain the solution here? What makes this particularly amazing? And half the time, I'm really struggling to understand that. By the way, if anybody wants to have a look at those from Omar, the link on his LinkedIn is below, so you can click through to him and have a look at those posts, because they are really informative. But yeah, I mean, that's usually my immediate question. And I'm scared to ask those questions, because I think, am I now exposing myself as a complete Luddite? I don't understand the technology, and therefore I'm asking this question. Or is it a valid point that I should, in terms of
better to be a Luddite with your money intact in your wallet than to be, seen as cutting edge and broke, right? Yeah. I think that's a terrific question. I think that's almost a foundational question, right? Because there are a lot of things I see as well where, people are building something on the blockchain. You're asking yourself, well, why are you doing that? I mean, what's the point of building it? And if they have a reasonable sounding answer, you're like, okay, fine, fair enough, right? I mean, this decentralized social media platform that I was telling you about, BitCloud, had investments from, all the big VC firms as well. And why? Because even though it was a very new model, but people were like, okay, well, it sounds interesting. And the point of a decentralized social media platform was so that, creators could directly get rewarded for their content, right? Without paying platform fees to a YouTube or to another, centralized platform. So you're like, okay, yeah, that makes sense. How monetized can you get? Well, if you have some big time, YouTube creator who switches and goes on to that network, well, then it becomes very, very powerful, right? I mean, look at TikTok. You would have thought that we don't need another video sharing platform. And now I would say that it is right up there with YouTube, and serving as kind of a different demographic, but also converging in interesting ways. So, there are instances where it's like, it's a new model, it's a new business model, and people have to even then be able to explain why this new business model is better than an existing business model. They have to explain why they believe it'll take off. And your question about, hey, could this be built in a different way, is an absolute fair question. The problem that happens, I've seen in startups, is they always adopt the buzzwords of the hype cycle, right? So, if at some point a startup has to say it's cloud-based and it uses AI and it's on the blockchain and it's this and it's that and it's all these things. And because these are keywords, unfortunately, the same, just like you put keywords on your CV, so you hope a recruiter picks it up. You stuff keywords in your pitch and you hope that this is like, oh yeah, that's what I want. I want to invest in a cloud-based blockchain platform. That's exactly what I want. And there you go, right? You've already made the sale without necessarily even getting into why you are building what you're doing. So this is always true. I mean, I've seen it many times, throw in big data, throw in, some buzzword or the other, and, you're kind of already you've passed the first filter regarding a number of investors.
All right, cool. What I will say is this leads me on to the fact that I have 2 blockchain startups that I'm looking to interview on the Clueless Capitalist. I'd love you to be able to join on in those calls as well, so we can talk to the founder, understand a little bit more about what they're building. These ones have been referred to me by somebody who's quite well versed in the space as well. So I do think that they have some interesting components and real value. One which is pretty close to my heart in terms of gold ownership, and I think this is a great way of taking 2 completely extreme things. One which appeals to those who really say the only way I'm going to preserve my wealth is to lock some gold into a vault and pack a few guns there too in case the world comes to an end. And then I'm interested to see how they're using the blockchain to actually democratize access to physical gold. And so I'm looking forward to that particular conversation. So if you're open to that, let's have a chat with the founder and see what they have to say about their business and what they're building.
Yeah, I'd be happy to do that. But what's kind of interesting for me is that you're conflicted about crypto, and yet here you are pro gold. There are traces of Luddite there. So, old world, new world, keep my gold under my bed kind of situation. Look, of course, gold is, I would say, the all-time asset, right? Even in today's market volatility, gold is held up fairly well, but there is life beyond gold, So the thing is that, I'm interested to hear what these founders have to say. I have to admit, I also get like a variety of pitches and it's all, each one is sort of a unique thing. And I'm, keen to see what problem these guys are looking to solve and their clever ways of solving them. I always have a soft spot for builders, so always happy to hear from them.
Yeah, no, absolutely. I think that's the same for me as well. I'm really excited to actually talk to a real founder now. The whole point of these conversations up till today was really just to understand the basics of blockchain, what is Web3, and trying to be a little bit more well versed in the terminology. And let's see where we can go with on that. Thanks for joining the call today, and we'll wrap it up today and look out for the next episode where we will be talking to a couple of Web3 founders, and we'll have Omar and Razi on as well, so that we can have a more holistic conversation, both from a person who doesn't really understand blockchain, but a little bit better now, thanks to Omar, and Omar, who's the banker on the blockchain and has a lot more understanding around the whole Web3 space. And thank you, and we'll see you on the next episode.